Okay, so here's some examples of audit evidence from our textbook. So we have some different scenarios here. These are 9 situations, and they each contain 2 different means for accumulating evidence. And then what they want us to do is down below here, for each of the situations, state whether the first type of evidence gathering or the second type is more reliable, and then which of the 6 factors that determine the reliability of evidence, which one is related to that one. So to start, our six factors of reliability of evidence are independence, whether there's an effective internal control structure, the auditor's direct knowledge, qualifications of the person that's providing the information, the degree of objectivity, and then the timeliness. So those are our 6 factors that determine the reliability of evidence. So that as we go through these, our first one says we can confirm receivables with consumers, so like you and I, just regular people or consumers, versus confirming accounts receivable with the business organizations. So the business organization is going to be the preferred one, because the consumer might not even understand the questions that are being asked or why. A business is going to understand when an auditor makes a confirmation what they're really trying to get at. So that would have to do with the qualifications of the person providing the information. So the business organization would be more qualified. Okay, then physically examine 3-inch steel plates versus examining electronic parts. So the one that's going to be the more reliable evidence is physically examining the 3-inch steel plates, because it doesn't require any real knowledge to do that, right? So like just your standard staff auditor can look to say, okay, look, here's 3-inch steel plates, count them, you're good. The examining the electronic parts, a regular auditor is probably not going to understand what those are. Are they good? Are they bad? You know what I mean? So that kind of goes back to the qualifications of the person who is providing the information. So the auditor probably isn't qualified to do that. Number 3, examine duplicate sales invoices when several competent people are checking each other's work versus examining documents that are prepared by one competent person and they are a one-person staff. So obviously we're going to prefer the one that there's people verifying each other's work. That would be the better evidence. And the reason is because they'd have a more effective internal control structure than just a one-person staff where there's no double checking. Then number 4, physically examine inventory parts for the number of units on hand versus examining them for the likelihood of inventory being obsolete. So again, it's going to be just physically examining them for the number on hand. Because again, any staff auditor can go see them, count them, verify that. If a standard staff auditor is not going to know if that inventory is obsolete. So like I worked at a plastic injection molder, and we had what we called gaylords of plastic pellets. Well, an auditor could go out and say, okay, look, here's a gaylord of plastic pellets. It's filled halfway full. It's black silicone. Okay, I'm good. But then if you had the plant manager come out, they'd say, oh yeah, that's a bunch of regrind and we really can't use it. So not like it's obsolete, but it's definitely not worth what you would think it would be worth. So then that is, again, going to go back to say it's the degree of objectivity. So like the person who knows the material knows if it's obsolete or not. The person who's just looking at it for how much is in there doesn't have that knowledge. Okay, then number 5, discuss the likelihood and the amount of a loss in a lawsuit against the client with the client's in-house legal counsel versus having that same discussion with the CPA firm's legal counsel. So obviously the discussion with the CPA firm's legal counsel is going to be better evidence because they're independent. The in-house legal counsel is not independent. Confirm the oil and gas reserves with a geologist specializing in oil and gas versus confirming a bank balance. So again, I kind of talked about that at the oil and gas company that I worked at. That's definitely a high level thing to calculate those reserves. So it's much easier to confirm that bank balance. And then if you confirm the bank balance, it's much more reliable. But again, that's going to go back to the objectivity of the person who's actually performing that audit. They're not going to know, just like the person up here didn't know if that inventory was obsolete. They're not going to understand all the math that goes into it or all the science that goes into it that the geologist would. Then number 7, we have confirm a bank balance versus examining the client's bank statements. So confirming the bank balance is going to be the better knowledge because that's independent. So, I mean, you're going to go right to the bank to get that. The client's bank statements, they're possibly downloading them. I mean, they'll have them in their possession. You know, it's possible that they could manipulate those if they had the skills to do it. So again, going right to the bank is the best way. Number 8, physically count the client's inventory held by an independent party versus confirming the count with the independent party. So if you could actually physically count it, that is going to be the better, more reliable evidence because it's a direct knowledge of the auditor. They're physically there counting it. Then the last one, obtain a physical inventory count from the company's president versus physically counting the client's inventory. So again, the auditor should always do it themselves, physically count the client's inventory because again, it's direct knowledge and they're independent. The company's president is not independent. So those are some examples there. Now then let's go down to number 36 where we look at some ratios. So they've calculated these ratios for us and they just want us to analyze to say, well, does anything look kind of out of line with these ratios? So I had to go. So these are our years. So we're starting back from 2015, we're up to 2019. So we got a 5-year trend. We don't have any benchmarks or industry standards, so we're just looking at the company itself. But so the current ratio is going down. So our current ratio is current assets over current liabilities. So we don't have the details to know, like, is cash going down, is accounts receivable going down, or maybe those are staying the same, but current liabilities are going up. But anyway, you look at that, whether it's the cash is going down or current liabilities are going up, it's a bad trend. So it's saying they're having less cash to pay their bills as they come due. And then the quick ratio is the same thing, but it takes inventory out. So then we see that it's definitely something to do with like our cash and our receivables compared to our liabilities because the inventory is not part of the quick ratio. And then it's still going down. And then our times interest earned is our earnings before interest and tax divided by our interest expense. So the more the better. The more times we can pay our interest expense out of those earnings, the better. So that's almost gone in half. So again, we don't have the detail numbers, but either our earnings before interest and tax have gone down or our interest expense has gone considerably up. So again, not necessarily a good trend, either one of those. I like to jump to these ones, our days to collect. So we were collecting at about 65 days, then it went up to almost 90. Now it's a little bit down from that, but still not good. So we're definitely having some trouble collecting on our receivables. Again, same with inventory. I like to jump to this one. Our days in inventory. So we started off at like 108 days. So what is that? Probably like 3 or 4 months. And then now we're up to 180 days, which is more like 6 months. So that's also a bad trend. Why do we have inventory hanging around for a lot longer than we used to? Then like our profit margin, I mean, it's gone down a little bit. That's not like hugely jumping out at me. Return on assets, again, it's gone down, but it's, you know, it went up and then it went back down, so it's not hugely concerning either. Now, return on equity has gone down more than half. So we were making 11 cents, you know, or 11% return on the equity. And then now we're down to 5%. And again, we don't know why. Is net income down? Have they issued more shares of stock? Has equity gone up? We need a little bit more information. But if we're thinking, okay, well, if equity has gone up, these earnings per share numbers are actually pretty darn consistent. So that's a little questionable also. So then it says, you know, like kind of what are your conclusions? Well, the conclusions are that the company's probably not doing that great. They seem to be increasing their liabilities, decreasing their earnings, or else increasing their interest expense. So going into more debt to finance their current operations. And then they're not having the return back to the shareholders. So it looks kind of bad. Then it asks, well, what, you know, based on what we're thinking, what else would we want to really do like a special emphasis on if we were auditing this client? So we'd want to take it one step further to figure out what the debt is, because there's no mention of debt in any of these ratios. We don't have that information. We'd probably ask for a detail of the accounts receivable to figure out what's going on there, a detail of the inventory to see, again, is there anything obsolete there? And maybe just a more, close analysis of the sales and the income, kind of what's trending are those going up or going down? So it's just a way to, again, to use kind of analytical procedures to look at these ratios and kind of come up with some things that jump out at us.